Welcome to the Frontline podcast, brought to you in association with the Atla Group. Atla Group is a collaboration of businesses with a collective history of over 130 years, bringing financial solutions to its clients in the world of accountancy, audit, advisory, fiduciary, and retirement benefit solutions. Visit atla.im today. On the Frontline podcast, we chat to leaders in business and successful entrepreneurs to bring you their in-depth and bite-sized opinions that will add value to you and your mind.
Ben, thanks for joining me today on Zoom. I appreciate you sparing us a little bit of time.
Yeah, thanks for having me.
So we just want to talk about responsible investment today, particularly around the subject and also Brooks MacDonald's position in regard to that. Perhaps to set the scene for listeners, perhaps you can just explain what it really is, a bit of background to it, and perhaps expand a little bit, certainly on I call it the vetting and the KYC process, because the responsible investing, I guess, falls into many categories, and just the stance as well on how you guys approach that.
Sure, absolutely. And I think the key thing there is, Martin, very much what you mentioned about it being a very broad subject space, and there's lots of different avenues within it. So in terms of framing responsible investment, the way that we look at it at Brooks MacDonald is really in two primary camps. And the first is really understanding the role that doing environmental, social, and governance analysis can play in all investment mandates. The fact that the risks around not doing ESG analysis can play to your investment portfolios and ultimately client returns. There's things around a company's environmental footprint, obviously a specific focus at the moment around carbon, or it's the way it runs its business and the social interactions that it has with both its employees, the wider community and wider stakeholders are increasingly under focus and scrutiny from policymakers, regulators and consumers. So there's very clear financial risks to companies that may not have been considered or as material 10, 20 years ago. So the way that we initially think about it is, how should we be thinking about this for all of our clients, regardless of whether they have set objectives around environmental and social criteria? So we've been doing a lot of work within the business over the last couple of years about how can we make assessments around investments, exposures to environmental and social risks and also opportunities. The second element of it is for those clients where they do have set objectives or clear objectives about what they want to achieve, in addition to their financial returns, around environmental and social characteristics in portfolios. So with that in mind, we've set up a service which we call the Responsible Investment Service, where we have two clear strategies where there are financial objectives attached to those, but we also have some clear environmental, social and governance criteria. The first is based on exclusions, what we call a void. Most of your listeners will be aware of this approach. It's quite clear, it's quite blunt in terms of a tool, but it's essentially highlighting certain products for us. So we concentrate on armaments, tobacco, alcohol, gambling, and adult entertainment, and ensuring that they are formally excluded from your portfolios in terms of all of the underlying funds processes as well. The second strategy that we have in place is what we call advance. So this is very much more the positive inclusionary basis for investing. And we frame it around 8 key themes. So we are looking at 4 environmental areas and 4 social areas, being cleaner energy, sustainable transport, water and waste management, health and well-being, safety, education, financial inclusion. So it's a very thematically minded strategy. What we're looking for here are investments which are positively contributing to those 8 areas through the products and services that they provide and sell. But also we take a slightly wider view of sustainability with those 8 themes, looking at companies across the global economy which are contributing through how they run their businesses. So, looking at how they treat wider stakeholders, their environmental policies, and ensuring that the management of their business is really taking into account the impacts they have in those areas. So it's a rather long answer to a potentially short question, Martin, but we frame it very much in those 2 categories in terms of our core services integrating, but it's not necessarily always the key determinant of investment selection. and then those set objectives for clients in terms of trying to meet their financial goals, as well as that set sustainability framework, be it avoid or advance.
Absolutely. And out of interest in an observer, how do you quantify those parameters?
Yeah, it's a real challenge at the moment for the wider industry in terms of quantifying a lot of that's involved in ESG analysis. There are a growing number of data providers in this space, and the data is getting better. So that's the first thing to highlight, because I think it gets a lot of bad press, and to some degree, understandably, and we would echo some of the points around the data. But I think it's also important to say that the data is improving, particularly over certain areas like carbon footprinting and a lot of the environmental measures that companies are increasingly being forced and pressured to report on. But it is also important to say that a lot of the work we do is around the qualitative assessment. So, as I say, whether this is for our core services and understanding key risks to our investments, or whether it's around those set objectives in our responsible investment service, a lot of our energy and attention and research goes into assessing process. It goes into assessing qualitative assessments of management teams, of companies' operations, because ultimately there are a lot of things within this broad space of ESG analysis which ultimately, in my view, cannot be quantified. So it's really about trying to understand and select investments and the management teams where you think that there's real intent in terms of their actions in these spaces, and there's clear policies and processes to help manage the impacts that they have, and ultimately always working towards a greater reporting framework from underlying companies through to fund managers, through to us, and through to end clients. So whether that's through quantifiable measures, as I say, like carbon footprinting, or whether it's through more qualitative narrative-based reporting to give end clients a better understanding of how their investments are positioned. And certainly, just to cap that off, in terms of our strategy, when I think about our advanced strategy around those 8 themes, something that we do is take a look at the underlying company exposures we have, and we look to align the underlying companies to our 8 themes where we think there is a clear alignment of their products and services to helping address one of those areas, which again, hopefully adds to less so a hard quantifiable measure, but certainly that communication tool for clients to understand where their investments are.
Yeah, it makes sense. So do you find sort of most, as with most things, performance is naturally a driver for most clients and individuals, that there's not necessarily a compromise, but sometimes there needs to be a compromise from a client if they're looking for perhaps the full ESG package, that perhaps the performance of I wouldn't say it's compromised, but they need to balance that with their wishes as well. And that must be difficult in your situation if that's the case.
Yeah, the way that I look at it is, instead of trying to understand where compromise might come, it's just understanding the characteristics of your portfolio. And if I look at particularly the division between our core services and our set strategies in the service, then our core portfolios, all of the investment decision making is around trying to maximize risk adjusted returns. So that's the role that ESG plays, is solely around understanding risks. Are they correctly priced in? Are we aware of them? And will that ultimately be detrimental to client returns? Obviously, on the other side of the equation, there are sort of more set objectives around what we're trying to achieve. Now, I'm very biased with the hat that I wear and the role that I play, that in my view, particularly if I think about the themes within our advanced strategy, in my mind, over long time horizons, looking forwards, I think these are areas of the economy and characteristics that shouldn't be viewed as being a compromise within your portfolio. In my view, they are as much a thematic way of investing, regardless of personal values. It's looking at sort of structural growth areas of our global economy that are increasingly supported by, as I say, both the top-down policy and regulations, but also bottom-up consumer trends and demands. So in my view, I don't think it should be a compromise, and it shouldn't be detrimental to client returns. However, it is also very important to highlight that there will be certain structural biases within those portfolios. And most notably at the moment, they tend to be towards certain sectors. namely in our portfolios at least, and most of our peers, it's technology, healthcare, and industrials, because that's where the greatest opportunities with those themes in mind are located. So this can be a clear driver in certain market environments and a headwind in others over short time periods. And to be sort of very clear, at the moment, they are providing some headwinds at the moment, as we've seen this rotation away from some of those more growth-minded sectors into some of those more value-orientated areas. So I would say that it's really important to be aware of biases lie in these portfolios and be aware what that might do over short time periods in different market environments. But as I say, if clients have a long-term time horizon, then in my opinion, they shouldn't necessarily be detrimental to longer-term returns.
Okay. And then in regard to the appetite around people looking for ESG exposure, where are you seeing that? Are you seeing that at the individual level, so retail? Is it family office? Is it corporates with investment portfolios? Where are you seeing that main appetite at the moment?
So I would say that the institutional space is probably further ahead than the retail market, and this has been the case for several years. So we're seeing a lot of large institutional mandates which have very set ESG and sustainability mandates in place now. But I would say that the kind of probably the speed of growth coming from a low base, it's important to note, it is coming from that retail part of the market. And something that we keep an eye on is the Morningstar quarterly sustainable fund flow report that they publish. It just gives you an idea in terms of, on a global basis, the kind of the growth of assets that are being put into this marketplace predominantly, and this is mainly looking at retail money. And we've seen consistent net inflows and growth of net inflows over the last couple of years. Now, it's ebbed and flowed a little bit over recent times, but just to put some numbers on it for you, I was looking at the Q1 report recently, and there has been a slowdown in Q1, but globally, there was about $97 billion of retail money that was net money that was put into sustainable funds around the world. So that was a slowdown on Q4 of about 33%. Now, given the nature of what markets have done and just investor appetite, it's relatively understandable. But I think the important part is actually if you compare that to the broader fund market, so funds that don't have a sustainable mandate in place. Now, the absolute number is larger, as you'd expect, but it's actually not that much larger. So net inflows in Q1 were $138 billion worldwide. So I think actually, if you look at that next to each other, 97 versus 138, then as a proportion, it's extremely high. And actually what we saw is that the percentage drop of 33% in sustainable funds was actually 73% in the wider fund market. So again, that reflects a weakening investor appetite. What it also, in my opinion, reflects is the fact that it's a disproportionately robust part of the market. So even though the net number fell, there's still sort of a growth of market share gain in that sustainable part of the market. So I appreciate there was a few numbers flying about there, but hopefully kind of the crux of what I'm trying to communicate there came through, that we are seeing sort of structural growth in these funds from across the market, with Europe being the key leader in this space still, but we're seeing an increase in interest from the States and other geographies as well.
Interesting. Thank you. And just to perhaps finish off, Phil, you've kindly joined us as well on Zoom. From an Alaman perspective, are you seeing more and more appetite in the ESG and clients asking about that, coming in and talking about that?
Yeah, thanks, Martin. The answer is yes. In my career, I think every meeting that I might bring up responsible investing, the level of engagement on the subject has increased significantly, and certainly here on the Isle of Man, that's no different. I would say that it forms a part of pretty much every meeting that I have, and a high level of interest. There's no doubt that this subject is forming an increasingly central part of all of our lives, whether that's taking a reusable coffee cup to the refuge, or me standing at the till in Tesco's hard thinking about, do I buy another carrier bag because I didn't bring enough with me? It is a part of each of our lives. I think the other thing there is, we are lucky enough to have this resource, and it's established now. Ben's built and run that responsible investment service since 2018. This intergenerational wealth transfer that's affecting all of us over the next few years, your business, Martin, IFAs and banks, this subject forms part of that. And we all need to have a robust proposition so we can have conversations and meet the needs for clients who've got aspirations that need to factor in this subject.
Yeah, no, couldn't agree more. Well, thanks, chaps. Appreciate you joining us on this Bitesize episode, and appreciate your time very much.
Thanks, Martin.
Thanks, Martin.
Thanks for listening, everyone.